Technologies Limited Q1 FY27 earnings conference call. From the management side, we have with us today Mr. Mohan Agarwal, Chairman and Managing Director, Mr. Ankur Singh, Director and Business Development, Mr. Yugal Garg, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and it may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Mohan Agarwal from CMR Green Technologies Limited. Thank you, and over to you, sir.
Yeah, thank you, Palak. Good evening, everyone, and thank you for joining us for CMR Green Technologies Q1 FY27 earnings conference call. I welcome you to our second earnings calls as a listed company. I also thank all our stakeholders, our shareholders, investors, analysts for the continued trust they have placed in CMR. Since listing, our focus has remained unchanged to build an institution that consistently delivers profitable growth, creates long-term value, and contributes meaningfully to India's circular economy. We began FY27 on a strong note despite an uncertain global environment marked by geopolitical tensions, supply chain disruptions, and price volatility. During the quarter, revenue from operations grew 65% year-on-year to 3,122 crores. EBITDA increased 27% to 139 crores, and profit after tax rose 22% to over 68 crores. In volume terms, sales grew 25% year-on-year, with aluminium business growing at 32%, supported by strong automotive demand and growing non-auto traction. Billets volume increased 149%. UBC volumes grew 333%. This is because both of them are in ramp-up mode and they are successfully ramping up. Next, one of CMR's key strengths is our ability to perform consistently across commodity cycles. Since aluminum prices are largely a pass-through in nature, we believe that EBITDA per ton per kg is a more meaningful performance indicator than percentage margin. So, in this quarter earning and also in future, we may see that the EBITDA as a percentage has gone up or gone down. That should not be taken as a real measure of our performance. Our per ton EBITDA is a greater measure of the performance. So now to maintain our margins, we have during the quarter have followed a strong hedging strategy, have diversified the scrap sourcing network, and have practiced a prudent risk management policy. And the EBITDA with all this improved slightly to 12 rupees 40 paisa per kg or 12,400 rupees per ton. Coming to CMR's positioning So CMR is India's largest secondary aluminum recycling company with installed alloy capacity more than 4 times that of our nearest domestic competitor. Over the 2 decades, we have built an integrated platform supported by strategically located plants, one of the most diversified scrap sourcing networks, joint ventures with 3 large Japanese companies, and long-standing partnership with leading automotive OEMs and their tier 1 suppliers, and also with non-auto companies like Hindalco or Jindal Stainless. So these strengths continue to differentiate us through consistent quality, reliable delivery, and operational excellence. During the quarter, we invested 53 crores in greenfield projects at Sulagiri and Bawal, while also advancing brownfield projects and technology-led initiatives at Tirupati and other locations. These projects are progressing as planned and are expected to take our installed recycling capacity beyond 7 lakh tons per annum by the end of FY27, significantly strengthening our leadership position and our ability to serve our customers better. Alongside capacity expansion, innovation and diversification remain central to our strategy. Our liquid aluminum business continues to deliver value through lower melting losses, reduced energy consumption, and significantly lower carbon emissions. And the liquid metal business is growing. Our recycled billet and UBC businesses are gaining strong customer acceptance across construction, renewable energy, electrical, and industrial applications, further expanding our addressable market beyond automotive. The automotive sector continues to be a key growth driver for CMR, with passenger vehicles and two-wheeler sales growing nearly 26% and 20% year-on-year, respectively, in Q1 FY27. While India's EV penetration reached 8.26% of total vehicle registrations in FY26. We are well positioned to participate in this transition with Ether Energy, one of India's leading pure-play electric two-wheeler manufacturers, as one of our new customers. Importantly, several of our existing automotive customers are also transitioning from ICE to EV production, allowing CMR to grow alongside its established customers while adding new EV-focused customers and strengthening our long-term exposure to the growing aluminum demand from electric mobility. Our non-ferrous metals business also continues to evolve in line with our strategy. We maintained our targeted aluminum to other non-ferrous sales mix of approximately 80-20. While automotive remains our core end market, we are steadily expanding into non-automotive applications. In FY26, our volume mix stood at 66% automotive alloys, 10% non-automotive, and 24% other metals. And we actually aim to rebalance it to 60-20-20 over the coming year, creating a more diversified and resilient earnings profile. Favorable regulatory trends are supporting the growing adoption of recycled aluminum and strengthening its long-term demand outlook. India's proposed EPR framework is expected to encourage higher recycled content across metals. Now, for aluminum, minimum recycled content requirement is increasing from 5% in FY28 to 10% over time. Alongside this, the EU's CBAM is accelerating the adoption of low carbon materials globally. In parallel, India's aluminum extrusion industry is expected to grow at 12% CAGR through FY29, driving demand for recycled billets, while the UBC ecosystem continues to expand with improving collection infrastructure and rising circular packaging commitments. So we see a lot of growth possibilities in the future on the back of all these things. Having spent over 4 decades in this industry, I firmly believe recycling is no longer just an environmental responsibility, it is an economic imperative. Customers increasingly demand cost-efficient, reliable, and low-carbon solutions, and companies with scale, technology, operational excellence, and strong partnership will be best positioned to benefit from this transition. At CMR, we remain focused on strengthening these advantages through capacity expansion, advanced technologies, operational excellence, and disciplined capital allocation. Our goal is not only to grow volumes, but also to improve earnings, diversify our product portfolio, and further strengthen our leadership in India's circular economy. With that, I thank all our shareholders, investors, customers, CMRians, and partners for their continued trust and support. We remain confident in the opportunities ahead and are committed to delivering sustainable growth, strong returns, and long-term value creation. Thank you.
So should we start Q&A session?
Yes, please.
Okay, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Dhananjay from Alchemy. Please proceed with your question.
Hello?
Yes, sir.
Hello.
Please proceed.
Hi. Hi, sir. Firstly, congratulations on getting listed. That's the first thing. And the secondly, just wanted to ask you, aluminum...
Sorry to interrupt, sir. Your voice is very low.
Can you hear me now?
Can you speak? Yes, sir. Please proceed. Yes, sir.
So I'm saying with the linking of aluminum prices to recycling, how does it work today? At a certain point, let's say aluminum went up to 2,400, 3,500 plus. Does that really increase demand for recycled aluminum? Is there any way, any like thumb rule or something along those lines?
If I got your question, let me first understand your question exactly. You're saying that the prices on the LME has gone up from about $2,500 to $3,500.
Yes.
And
does that increase?
That adds to growth of demand.
Yes.
Is that your question?
Yes.
Really, look, such a large increase in metal prices usually would be counterproductive to consumption because it would attract substitution. But if you see the overall metal complex, aluminium, copper, brass, zinc, nickel, everything has been going up so much. So the substitution risk is not really there. So we don't see that. Any additional demand is not really dependent on the price being high. So, but because of the inherent qualities of aluminium being the favorable weight to strength ratio, that it is 1/3 the weight of steel and can achieve similar strengths of steel. Because of that, the consumption of aluminium should keep growing. And recycled aluminium, because of the very high carbon impact that it has, favorable carbon impact, that it has a carbon impact of only under 300 kgs per ton against primary aluminium of nearly 16 tons per ton. Because of that, the recycled aluminium consumption would also keep growing. I mean, there are a number of things I can go on and on, but have I answered your question?
Sure, sir. This is helpful. I guess I'll ask a different way. Is there like when I'm just trying to understand, does it increase the requirement? Like today, let's say if a producer, someone who requires aluminium, let's say if the primary aluminium goes up a certain point, do they start wanting more recycled aluminium? I'm just trying to get if there's any like connection along those lines.
It does happen. Look, primary aluminium is the price leader. Secondary aluminium follows the primary with a lag. So during this lag times, the demand tends to go up a little, but really not so substantial, because look, recycled aluminium is gaining market share, is in consumption. At this moment of time, India consumes 40% of its aluminium consumption comes from recycle, and recycle is growing at about 13% per annum, while primary is going at about maybe 7 or 8. So there is a constant increase in the recycled content to the overall consumption. So this trend will continue irrespective of prices. So these short-term price disruptions don't really change the way the consumption pattern evolves.
Sure. This is helpful. And so secondly, for sourcing, does sourcing also get more difficult if prices increase sharply? I'm just trying to wonder, for your input, will sourcing also get much more harder, difficult?
Really, it is not so price dependent. The higher price or the lower price does not really change the availability of scrap.
Oh, okay, fine. Sure. This is really helpful for understanding. Thank you.
Thank you, sir. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference call, please limit your question to 3 per participant. The next question is from the line of Pranav Jain from Ageless Capital Finance. Please proceed with your question.
Hi, sir. Thank you for the opportunity and congratulations on the result. So, just at the outset, sir, a few of your peers explicitly say that they don't do aluminium recycling because it cannot be hedged. But based on our previous con calls, I believe we do hedge it. So, can you please explain what are we missing out on here? How do you hedge your aluminium exposure?
Thanks, Pranav. Look, hedging of aluminium, secondary aluminium, is more complex. It is complex because, as I explained in my previous answer, that recycled aluminium pricing follows primary with a lag. So it is not a mirror reflection of where the LME is moving. Plus, the auto customer also give us a cost plus pricing. So with both these two things, we have to find a very fine balance in hedging, which at CMR over such a long period of time, I think we have formed that balance. We have found that balance, and now we kind of part of our exposure, we keep it, we leave for the customer cost of pricing, and part of it we hedge on the LME. So this formula or this balance that we have is working quite okay for us.
Oh, perfect. So we do hedge it. That's great. Sir, and just more data keeping question. Can I know the cash flow from operations for this quarter?
Yeah, I will let Yugal.
Hi, Sanam. My cash flow situation is negative during this quarter also because prices has been moved drastically during the quarter. Sales realization is near around 226, 230 in last quarter, and in this quarter 325. So around 40% prices has been increased. Therefore, the working capital requirement also increased. So overall, my cash from operation is negative.
Understood. Got it. And so lastly, I remember on the previous Concall we had said we were looking to improve our working capital, specifically inventory. Can you dwell on how do we plan on improving our inventory and more optimizing our working capital further?
We actually want to reduce the number of days of inventory that we are holding in our plant. So we have recently started a AI-enabled system for tracking our imports. So that we have been testing for many months now. So with that, we are confident that we will be able to reduce our inventory number of days. We have actually we have gone to about 40 days of inventory from 45 days that we recorded in the previous quarter. And we have actually reduced our cash conversion cycle to 65 days in this quarter from about 69 days in the last quarter.
Got it, sir. That's great.
We are still working on this, and we will reduce the inventory and subsequently our working capital cycle.
Got it, sir. That's great. Thank you so much for the opportunity. I'll join back in the queue.
Thank you.
Thank you, sir. The next question is from the line of Raj Shah from Fident AMC. Please proceed with your question.
Yeah, thank you for the opportunity. My first question is on our other expenses.
Sorry to interrupt, Raj sir. Please, can you speak little louder? Your voice is very low.
Yeah, can you hear me now?
Yes, sir.
Yeah, I was asking on other expenses, they have increased sharply this quarter, also close to around 20% growth on a quarter-on-quarter basis. So what is the nature of expenses that have increased?
Other expenses also include the you can answer this.
Mr. Virender will answer this question. It is just because of there is a 36 crore of rupees which is due to the cash flow hedge, it is just a bifurcation of the hedge presentation. If you remove the 36 crore of rupees, there is minimal incremental from the last quarter.
Another expense.
Yeah.
So the increase is only 36 crores.
36 crore.
Mr. Raj?
Sorry, your voice was not very clear.
Mr. Raj, during the quarter, 36 crore rupees we have additionally loaded on account of the hedging. Otherwise, all the other expenses remain broadly in the line with the same in the March quarter.
Understood. And that would be notional expense as in on hedging, right?
Exactly.
Understood. Okay. Secondly, in terms of volume, so how do you see the domestic versus export split going forward? I mean, do we see more domestic penetration increasing because EV penetration in India is increasing? And how is the pricing for domestic customers versus export customers?
Domestic, definitely we are very excited. Auto is growing very well. Auto continues to be one of our major customer base, and at the same time we are seeing a lot of growth in the wrought alloys business as well. So domestic would stay to be our major focus. Export, we have done about 3.4% of our turnover came from exports in last year. So we more concentrate on niche products export rather than regular. We do a lot of niche product exports, and our concentration will continue to be to export more and more niche products to niche markets. We export regularly to Japan, to Europe, in Belgium and Germany, to Southeast Asia, to Thailand, and also some products to China. So I suppose our strategy will continue to be the same.
Understood. So just lastly, assuming that aluminum prices stay at these levels, will it be possible for us to be operational cash flow positive during this year? And consequently, what will be the debt levels for this year by the end of this year?
Cash flow negative, I suppose, is a matter of increased working capital requirement. I think as the prices stabilize, we will definitely go cash flow positive because we are reasonably profitable. And sorry, what was your next question after this?
In terms of the debt levels for the end of this current year, I mean, including working capital.
We are trying to reduce debt level with reducing our inventory conversion cycle. So as that happens, the debt levels should go down. But it is also a matter of how much increase, how much growth in our production and sales happen. So as the number of days, we definitely look at reducing the debt. Yeah, you really want to add something?
Working capital cycle, and another is a debt equity ratio. So we would generally, historically, we maintain the 0.5 debt equity ratio, and we also like in future we will maintain the same ratio. But definitely it is around 8.6 or 0.86. So definitely it will come down when the prices got stabilized.
Yeah, it is your focus area.
Understood. Thank you so much.
Thank you, sir. The next question is from the line of Vishnu from ICICI Prudential AMC. Please proceed with your question.
Yes, hello. So there seems to be some difference between the EBITDA number reported in last PPD versus this PPD for Q4 and as well as FY26.
Vishnu?
Yeah.
Yeah. We have adjusted our EBITDA with the other, some of the other income item, which is actually part of the operating in nature. But due to the accounting standard requirement, we have to classify into the other income. So we have mentioned the adjusted EBITDA. The two items are there, is a foreign exchange gain and the other ineffective portion of the hedging on commodity.
And for FY27, we are still guiding for 25% growth, right?
Yes. That is our the future. In terms of volume.
Yeah.
Yeah, that's...
Okay, yeah, that's all. Yeah. Thank you.
Thank you, sir. The next question is from the line of Dheeraj Ram from 360 ONE Capital. Please proceed with your question.
Hi, sir. Thank you for taking up the question. Sir, you guided for 25% volume growth for FY27. So, do you make any changes to this, or do we still...
Sorry to interrupt, Dheeraj, sir. Your voice is very low. Can you speak a little louder?
Yeah. Am I audible now?
Yes.
Yeah. So your guidance for volume guidance for FY27 is 25%. So right now for this quarter, aluminium volume growth is around 8%. So do we hold this for FY27?
Dheeraj, I will be very frank. I don't want to build expectations. I want to meet expectations. The 25% is definitely our internal target. We have invested because of the two plants at Tirupati and Odisha, which are ramping up, and also some brownfield expansions, and also the growth of our customers. So everything put together, we definitely believe that, yes, we should be able to achieve the 25% growth. Though at the same time, frankly, I don't know from where it came, because we like to manage expectation rather than build expectations. But anyway, while it is out there, Dheerajji, so okay.
In Q1,
In Q1, we have done 25. Okay, you have extrapolated that to the year. But yes, internally we have that figure and we will do everything to achieve it.
But Q1 versus Q1 growth has been 25%, not 8%.
No, he's saying 8% is the...
It's the volume growth, sir. I was talking about the volume growth.
Volume growth we achieved 25% in the first quarter.
What is your exact question, Dheeraj? Can you repeat?
So last quarter, we have guided for 25% volume growth in FY27 for the entire year. So my question is, do we still hold this? Or do we want to make any revisions for this?
In Q1, we have achieved the target and we are expecting to achieve.
Yes, we holding it.
Okay, and your peers in terms of other metal recyclers have faced challenges in sourcing of scrap, and mostly that was towards import of lead or copper or other metals. Do we see this problem happening for us, or do we see this going forward? How are we managing, or what steps are we taking to mitigate this?
Look, sourcing of scrap is getting challenging. There are countries which are putting restrictions on export of scrap from those countries. So it is becoming more challenging. How we are doing is that we have expanded our sourcing base. And frankly, while on the growth projections that you have, we trust that we will not face any challenge in sourcing the scrap quantity for it. We have also increased our sourcings from the domestic sources in India. So we are looking both at domestic and import sourcings, and we believe that it will not come in the way of our growth projections.
Okay, and last question, sir.
Sorry to interrupt, Dheeraj, sir. May we request that you return to the question queue for follow-up?
Sure.
Thank you, sir. The next question is from the line of Nikhil Gandhi from Bajaj Life Insurance. Please proceed with your question.
Hello, sir. Thank you for the opportunity. Just a question to understand, how should we see the unit metrics of the company? So if we adjust around 36 crores, which will be close to 2.8 to 3 rupees per kg, the GP margin comes to around 27 rupees per kg, and the other expenses will be close to 10.3 rupees per kg. So this was similar to that of Q1 of FY 2026. So excluding the hedging cost, how should we see the GP margin and EBITDA per kg for ourselves for FY 27, as well as some light on FY 28?
Virendra, you want to explain this? Come here. Can you repeat the question, please, Nikhilji, because you're not really... what you're saying is that you want a GP margin, whether it is expanded or contracted. Is that your question?
Yes.
But this is with respect to about 36 crores of hedging cost.
Yes, sir.
कुछ बढ़ जाएगा ना निखिल. We have really not understood GP margin कितना है हमारा EBITDA ना निखिल. निखिल
नहीं. Sir, I meant to say is कि our GP margin is close to 30,600 rupees per ton. So if we adjust the hedging cost, it will be close to 27,300 or 400 rupees per ton. So this will be similar to that of Q1 of FY 2026. So I just wanted to understand how should we see the GP margin trajectory?
But where have you got this figure of hedging cost adjustment and lowering the GP margin with that? Because hedging should not affect the GP margin at all. And we are seeing improvement in our GP margin from the last year.
Okay. Sir, basically what I was doing is I was subtracting your hedging cost, which is in other expense, from GP margin to gauge what is the actual GP margin if we consider the hedging cost.
You have to add it. You cannot subtract it. Nikhil, I'll explain you the unit metrics which you are asking.
Our gross margin on per kg basis is around 27 rupees per kg. And another is major expenses is salary wages is 5 rupees per kg. And another major item is
Is your question answered, Nikhil sir?
Nikhil ji, just 1 minute. Our GP margin, as I can see, is about 27,450 in the current quarter that we're talking about. From where did you get this 30,600? इसलिए expense लेके देखिए hedging goes directly to raw material, I think. So our GP margin at 27,450 is better than in FY26. At that time it was 26,000 rupees. So it has improved. I think it's considered. So we haven't understood your.
I think that 36 crores of.
Sir, I will take this question offline then.
Yes, please. Thank you.
Yeah, sure. Thank you. That's all from my end. Yeah.
Thank you, sir. The next question is from the line of Viral Makwana from Valum Capital Advisors. Please proceed with your question. Viral sir, please proceed with your question. Your line has been unmuted. As there is no response, we'll take the next question. The next question is from the line of Deepak Poddar from Sapphire Capital. Please proceed with your question.
Yeah, I'm audible, sir?
Yes, sir.
Yeah, thank you very much, sir, for this opportunity. So just first I wanted to understand on EBITDA per kg. I mean, currently we are at about 65% capacity utilization. So as you increase the utilization level and plus the new capacity is also coming through. So how should one see your EBITDA per kg? I think it was around close to 12 rupees this quarter, right?
Sorry to interrupt, Deepak, sir. Your voice is not clear.
Hello, am I audible now?
Yeah.
Please proceed.
So just wanted to understand EBITDA per kg trajectory given your capacity utilization will improve, yeah.
Look, traditionally in our business we utilize capacities up to about 70-75%. We are doing 65%. Though what you say makes sense that our EBITDA should actually improve, but our guidance, for our guidance, we maintain 12 rupees per kg as the EBITDA. For our guidance, we will maintain it at 12 rupees. We could do better maybe, but for guidance, we will maintain it at 12.
Okay.
Yes.
Okay. And on secondly, on your hedging cost, I mean, does it keep coming every quarter? I mean, how should one look at your hedging cost?
The hedging cost is the cost that we pay to the brokers and the LME, which is very minimal. Otherwise, hedge is just maintaining our profitability. It works reverse to the physical profit or excessive loss or profit. So that is a very minimal cost.
The 36 crore is not a hedging expenses. If you are considering that 36 crore is a hedging expenses, it is not the case.
36 is because of the movement of the pricing, right? I mean,
yes.
Since you have hedged it. Hello?
It is this entry passed on account of accounting standards.
I got it. Okay.
Yeah.
Okay. I think
It
that's
is
very helpful.
not really. I don't know.
It is not a conduct expenses, sir.
I don't understand.
This is notional entry.
It is not a repetitive expenses. Yeah.
I got it. I got it. I mean, that's very helpful, sir. That would be it from my side. Thank you so much.
Thank you.
Thank you, sir. The next question is from the line of Bhavika Singhvi from Niveshaay. Please proceed with your question.
Thank you for the opportunity. Am I audible?
Yes, I will.
Yeah. So the first question I have is I need to understand that how the prices of secondary aluminum work. Like, as you said that it's cheaper than the primary aluminum in the last call. Can you tell me like how one should track the secondary aluminum prices, and in this quarter particularly Q1, did we had like good realizations or it was impacted? Because if I see the gross margin, it has reduced like from the previous quarter. So can you help me to understand that?
Firstly, Bhavika ji, the price of secondary aluminium follows that of primary aluminium with a lag. While primary aluminium can move very aggressively, those prices, secondary aluminium follows with more stable trajectory. For various reasons, historical and the cost of secondary aluminium is always seen as lower to that of primary. I think it's a matter of economics because primary you can use for anything. It has a universal application, and when you go to secondary material, the application becomes restrictive in the sense that while the quality of primary or secondary is the same, just as an example, a beverage can scrap will go into beverage can. Scrap coming from auto shredding will go into production of auto alloys. A scrap from extrusion will go into production of billets for auto production. So the restriction is only to this extent that we must segregate the scrap for its right application to get the maximum value. Otherwise, secondary aluminium can be used practically for everything. While on the other hand, a primary aluminium, a 99.7% pure aluminium, which still needs to be alloyed, which is not pre-alloyed, it can be used universally for any application. So that is why primary aluminium prices are higher and secondary are comparatively cheaper. And this has been the case in the past, and I believe this would be the case in future as well. Your second question, change in our gross margin from this. Actually, no. For the year, you have the numbers for quarter. This is what it is. Now, where is the gross margin here?
Okay. That answers my question. And also, second question, as we have the tie-ups with Hindustan Zinc and Hindalco, can you tell me how much capacity is coming and what's the status of those capacity? Like for Hindalco, we are establishing Odisha unit. So what's the total capacity we are planning for this particular customer, and how the ramp up is expected for like the both Hindalco and the Hindustan Zinc?
With Hindalco, we have put up a plant in Odisha with a capacity of 48,000 tons per annum. That plant is ramping up. As I had explained in my now this quarter, the production has gone to about 6,000 tons for the 3 months. It should actually operate nearly at 4,000 tons a month. So we are ramping up. I trust within this financial year, we should have reached to full capacity utilization at Odisha. As far as Hindustan Zinc is concerned, we have signed an MOU with them, but there is nothing definitive which has still been finalized. So no activity for construction of a plant has yet started. We are still in discussion with them. So it will take a while before things move there.
Got it. So the last question, as you mentioned.
Sorry to interrupt, ma'am. May we request that you return to the question queue for follow-up?
Just a little bit, like it will not take much.
Sorry to interrupt, ma'am.
Okay.
Please return to the question queue. Yeah, thank you. The next question is from the line of Jigar Jani from Nuvama PCG Research. Please proceed with your question.
Yeah, hi. Thanks for taking my question. Just two questions. First is, how much of your revenues is on a cost pass on? I believe you said to automotive customers it is cost plus model. So how much percentage of revenues would be broadly cost plus?
Look, our sales to auto is about 60% of our 66% last year of our total aluminum sales, of our total sales. And auto is usually on cost plus model, but purely it has to be also, there has to be a hedging also involved with it, which I tried to answer to Pranavji in my earlier question. So it is a balance of both the things. Cost plus hedging.
Sure. Okay, great, sir. And just second question quickly is for your liquid aluminium part of the sales, I believe it would be closer to 40% of your aluminium business. Would the profit margins in terms of EBITDA per ton be very different than your alloys in this segment?
Look, liquid aluminium today is forming more than 50% of our aluminium sales. Going forward, we expect the liquid aluminium to contribute more. So growth in liquid metal sales is going to be higher than growth in ingot sales. The profitability in liquid metal is comparatively better. But more important than profitability per ton basis, it is the lock-in that we get with the customer. The predictability of sales that the liquid metal brings is, and the the entry barrier that it creates, plus the benefit that accrues to the customer by using liquid metal instead of melting solid ingots, is all the things together which actually contribute more towards sustainability of our profitability. and sustainability of the business.
So will you be able to quantify on a broad range base how much better it would be? Like if 12 rupees is your target, how much better it would look good?
Is actually very difficult, Jigarji, because look, we have tried to do it, but we don't really. It's a small difference, not very huge, but we don't have any real definitive figure that I can quote to you. But liquid metal is good business because it brings more value for our customers. So when our customers get more value, then we also kind of get a better profitability from that business.
Understood, sir. Thank you so much for answering my questions and best of luck, sir. Thank you.
Thank you.
Thank you, sir. The next question is from the line of Himanshu Bisani from Pinpoint X Capital. Please proceed with your question.
Hi, sir. Am I audible?
Yes, sir. Can you speak a little louder, Himanshu, sir?
Sure. Thank you, sir. Thank you for the opportunity. So my question is on our EBITDA per kg, which has moved from almost 6.9 in FY24 to almost 12.4 this quarter. I just wanted to understand what has been the driver for this. Is it scale or some product mix? And what kind of levels you look at it fundamentally, looking at our utilization is around 60-65%, and it's a spread business. So any light on that, sir?
Thank you, Himanshu. EBITDA moving from 6.9 to nearly 12.40 currently is a mix of a lot of things. The improvement in our operational efficiency, the hedging mechanism that we have been able to incorporate, the increase in our capacity utilization. So all these things put together have been able to.
EBITDA margins have gone up from 12 to 12.4.
6.9. So all these things have contributed to improvement in the EBITDA margin. While internally we do target increase in this EBITDA margin, but for the guidance to the street, we are maintaining 12 rupees as the EBITDA margin on a sustainable basis. Is that okay?
Understood.
Thank you.
Sir, second question on the growth side. So 25% volume growth, and we are moving our capacities from 6.15 to almost 7 lakhs. So just wanted to understand on this volume growth guidance, is it more of a base case number, and what kind of underlying growth you have been looking at, because the prices of primary aluminum has already gone up significantly. So this 25% number is a base number that should be considered, or how should we look at it?
Look, this 25% growth guidance is basically based on we are building 2 more plants. Both of them will actually commission. But there are 2 plants that we had commissioned at the beginning of this financial year at Tirupati and at Odisha, and those plants are ramping up. So that plus the growth in our existing customers in the auto sector is going to give us a confidence that we should be able to achieve this growth number. And price increase or decrease really does not have a direct bearing on the demand or our volumes. The prices are, our volume is quite independent of price movements.
Understood, sir. And so lastly, on molten liquid, liquid aluminum business. So as you mentioned that we give some extra value to our customers, and the moat around it, that it needs to be supplied in 45 to 60 minutes. what kind of margins that we enjoy relative to our normal ingot business?
As I had explained that our profitability in liquid business is higher as compared to ingot business. But the profitability is just not from that differential. That differential we have not been able to quantify, but yes, it is comparatively higher. But the main benefits of liquid metal, as I explained, comes from predictable and consistent business with the customer and growth with the customer. We are tied up together. So that interdependability is what is, they get benefited, and in turn we also get benefited. It's a win-win relationship.
Got it, sir. Thank you so much, and all the best.
Thank you. Thank you.
Thank you, sir. The next question is from the line of Madhur Chaturvedi from MAIQ Investment Advisors LLP. Please proceed with your question.
Hi, sir. Good evening. Congratulations on a great set of numbers, and very happy and proud to be part of this company. So just wanted to clarify one statement we made about the working capital, Mohan. You had said that we have reduced our inventory by 5 days. Just wanted to confirm that quarter on quarter.
Madhurji, yes, we have reduced our inventory quarter on quarter. As on March 26, our inventory was 45 days of sales, and as of 30th June, it is now 40 days of sales. So on quarter, we have reduced. But if you look historically, then also we have been hovering between 40 odd days. So if you compare with historical, it is not such a great reduction. But going forward, we do plan to reduce our inventory with the new software, AI-driven software that we have introduced. We believe that we should be able to reduce our inventory days.
Absolutely. It's heartening to see that at least we're headed in the right direction, even when the macro environment, the global climate is not that great. So just one more thing on the operation, sir. Because of the Hormuz crisis, has our power cost been impacted this quarter? Has that been fairly stable?
Because of the Hormuz crisis, look, for energy we use oil and gas, mostly oil. So oil prices have gone up. We have tried to mitigate our cost increases with better purchasing and booking kind of a little longer term with our suppliers or getting more discounts from them. So by having said that, in our industry, we are also able to pass on the cost to our customers. So that both these things put together would kind of help us to maintain our profitability.
Understood.
And has been the case.
Understood. So, and one last very quick question from me. So just to understand, given that, our sector is poised for such a big tailwind, so how big, if you don't want to name them, that's fine, but so how big would the next biggest company be in our sector, where we will be 7 lakh tons by the end of the year? How big would the next person in India be, sir?
We said we are more than 4 times the next one. So the other one would be maybe 1.5 lakh tons or 1 to 1.5 lakh tons, between that.
Understood, sir. Understood.
And
that's it.
Normally, we have seen them to be under 1 lakh tons. What I know of is less than 1 lakh tons.
Understood. Understood, Mohan. Thank you. Thanks a lot. That's it from my side, sir, and looking forward to the next many years, sir.
Thank you, Madhurji.
Thank you, sir. Ladies and gentlemen, in the interest of time, that was the last question for today. I would now like to hand the conference over to Mohan Agarwal, sir, for closing comments.
Thank you, everybody. Thank you for joining us on the call. Thank you for sparing your valuable time. We at CMR, we are new to the street. It is only our second call. But one thing that I can assure is that we will continue to work diligently to continue our growth, both in terms of top line and bottom line, and be innovative and do everything to take care of the interests of all our stakeholders. And I'm very happy for the very high quality of questions that have come up today, and I hope I have been able to answer them to their satisfaction. Thank you very much. I am obliged.
Thank you, sir. On behalf of CMR Green Technologies Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.